Introduction and author biography Jesse Livermore. Jesse Lauriston Livermore stands as one of Wall Street's most legendary figures. Revered by traders and feared by markets, he earned nicknames such as the Boy Plunger and the Great Bear of Wall Street. His career was a saga of spectacular rises and devastating falls, yet his trading principles remained timeless, shaping the discipline of modern speculation. Born in Shrewsbury, Massachusetts, to a modest farming family, Livermore left home at the age of 14. He began his journey in a bucket shop, chalking up stock quotations. From this humble role, he developed a sharp eye for price action and market behavior, traits that would define his trading genius. By his late teens, he was already making money consistently from short-term speculation, outsmarting operators twice his age. Livermore's career was marked by dramatic swings in fortune. He amassed and lost millions more than once, becoming both a cautionary tale and a symbol of the market's unforgiving nature. Yet, his triumphs were nothing short of historic. In 1907, he famously shorted the market during the panic, securing a fortune. Again in 1929, he positioned himself ahead of the Great Crash, walking away with profits exceeding $100 million, cementing his reputation as one of the greatest speculators of all time. What set Livermore apart was not luck, but discipline and method. He believed markets moved in recognizable patterns driven by crowd psychology. His strategy centered on trend following, pivotal points, and pyramiding into winning trades. He never tried to predict. Instead, he observed, waited for confirmation, and acted decisively. His famous dictum still guides traders today. The market is never wrong. Opinions often are. Equally important, Livermore emphasized the psychological dimension of trading. He understood that fear, greed, and impatience destroyed more traders than bad analysis ever did. For him, survival meant cutting losses swiftly, letting profits run, and adhering to ironclad discipline. Although his life ended tragically, Livermore's legacy lives on through his enduring principles and his book, How to Trade in Stocks. This work distills decades of hard-earned experience into clear, actionable rules, an enduring manual for anyone who seeks to navigate the turbulent seas of speculation with professionalism and discipline. The laws of market movement. Markets are not random. They may appear chaotic on the surface. Ticks flashing across screens, bids and offers constantly changing, traders shouting in pits or algorithms executing in milliseconds. But beneath this seemingly turbulent sea lies structure, rhythm, and repetition. For more than a century, professional traders on Wall Street have sought to decode these patterns. Those who succeed understand a simple truth. Price is never static. It is always in motion, guided by forces far greater than any single participant. This chapter examines the timeless laws of market movement, the underlying principles that drive price action, and the lessons that generations of traders have distilled from both triumph and ruin. 1. Price reflects collective judgment. The first law of market movement is that price is the final verdict of collective judgment. Every opinion, every forecast, every research report, every whisper of news ultimately converges in the tape, the constant stream of prices and volume. A stock may be overvalued on paper, a commodity may appear scarce or abundant, but none of these matter until the market confirms it in price. On Wall Street, professionals often remark, the tape tells all. It does not lie. What traders believe, what they fear, and what they hope for, all of it is expressed in the price action. This recognition separates the professional from the amateur. The amateur clings to opinions. The professional follows the market's message. The market is not interested in your belief about where a stock should trade. It moves according to supply and demand. Prices rise when demand overwhelms supply, and they fall when sellers dominate buyers. Everything else is commentary. Number 2, markets move in trends. A second enduring law is that markets move in trends. Prices rarely drift sideways indefinitely. Instead, they advance, decline, and occasionally pause before resuming direction. Trends are born when conditions change, when earnings exceed expectations, when liquidity expands, when a new technology disrupts industries, or when fear overtakes confidence. Once in motion, trends tend to persist because of crowd psychology. Early buyers encourage others to follow, momentum attracts speculators, and institutional flows create sustained movement. Wall Street veterans understand that the greatest fortunes are not made by catching every small fluctuation, but by identifying and riding the major trends. The trend is the trader's ally, providing both direction and context. Fighting a dominant trend is like stepping in front of a speeding train. It may slow briefly, but the force behind it is relentless. 3. Cycles govern market behavior. Beyond trends, markets move in cycles. Prosperity leads to excess, excess leads to correction, and correction lays the groundwork for recovery. This ebb and flow mirrors human nature itself, optimism giving way to greed, greed collapsing into panic, and panic slowly turning into hope once again. On Wall Street, cycles are not confined to decades. They occur on multiple time frames, intraday cycles, where liquidity shifts from morning volatility to afternoon calm. Intermediate cycles, reflecting earnings seasons, fiscal policies, or quarterly flows. Secular cycles, spanning years or even decades, where bull markets mature into manias and bear markets cleanse excesses. A skilled trader studies these layers of rhythm, aligning short-term tactics with the broader wave. The market, after all, is not a straight line. It is a series of recurring patterns shaped by recurring human behavior. Number 4, crowd psychology rules the tape. If there is one law that governs all others, it is this: markets are driven by psychology. Behind every uptick and downtick lies emotion, fear, greed, hope, regret. Crowd psychology explains why markets overshoot fair value. In times of euphoria, buyers chase prices higher not because fundamentals justify it, but because they fear missing out. In times of panic, sellers dump assets at any price, not caring about intrinsic worth, but desperate to escape losses. The professional speculator does not fight this psychology. He harnesses it. He recognizes that the market is a mirror of mass emotion. By reading the crowd, by sensing when optimism has reached mania or when despair has reached capitulation, he positions himself ahead of the turn. The law is simple. Human nature does not change, and therefore market behavior repeats across generations. Number 5. Support, resistance, and pivotal points. Another law of market movement is the existence of levels that matter, prices at which supply and demand reveal themselves decisively. These are known as support and resistance, or in more advanced language, pivotal points. When prices approach a pivotal level, volume swells and the market reveals its hand. If buyers absorb supply and drive prices higher, a breakout occurs, signaling strength. If sellers overwhelm demand, the reversal marks weakness. These levels are not mere lines on a chart. They are the battlegrounds where bulls and bears test conviction. Wall Street traders pay close attention to these inflection points. The break of a key level can mark the birth of a trend, while a failure at resistance can trigger swift liquidation. The law here is discipline. Wait for the market to declare its intent before committing capital. Number 6. Volatility expands and contracts markets breathe. Periods of quiet consolidation are followed by bursts of violent movement. This phenomenon reflects another law. Volatility is cyclical. When markets grow calm, traders grow complacent, options cheapen, and risk appears distant. This sets the stage for sudden shocks as complacency is shattered by unexpected news. Conversely, when volatility explodes and panic grips the crowd, conditions eventually normalize. Professional traders respect volatility as both a risk and an opportunity. They reduce exposure when the storm rages beyond control, but they also prepare to strike when volatility signals the beginning of a major trend. Number 7. Liquidity is the lifeblood. Another immutable law is that liquidity drives movement. Prices do not rise simply because an asset is good. They rise because there are more buyers than sellers willing to transact at higher prices. Similarly, crashes occur not solely because of bad news, but because liquidity evaporates. Buyers step aside and sellers rush for the exits. This is why institutions and seasoned speculators monitor not only price, but also volume. Volume confirms conviction. A rally on strong volume signals genuine demand. A rally on thin volume warns of fragility. Liquidity is the current that carries the ship. Without it, even the soundest vessel stalls. The market punishes certainty. The market thrives on uncertainty, and one of its harshest laws is this: certainty is dangerous. When everyone agrees, the opportunity is gone. Consensus breeds complacency, and complacency breeds reversals. On Wall Street, the most profitable trades often emerge from points of maximum disbelief, when the crowd is skeptical of a rally or dismissive of a recovery. By the time headlines confirm the trend, the smart money has already positioned and is waiting for the latecomers to drive prices further. The professional remains flexible. He never allows conviction to blind him because the market is always greater than the individual. To survive, one must adapt, not insist. Number 9. Time filters noise. Another law often overlooked is that time filters noise. Price movements that appear chaotic on a 1-minute chart often reveal clarity on a daily or weekly horizon. Similarly, what seems obvious on a long-term chart may contain countless traps in the short term. Professional traders learn to operate across multiple time frames, aligning their trades with the dominant trend while managing risk in the short term. This perspective prevents overreaction to meaningless fluctuations and keeps focus on the larger picture. Number 10. Risk and reward are inseparable. Finally, the most unforgiving law of market movement is that risk and reward are inseparable. Every opportunity carries danger. Every potential gain requires exposure. There is no reward without risk. What separates professionals from gamblers is not the absence of risk, but the management of it. They know that the market will always move, sometimes violently, sometimes deceptively, but their survival depends on position sizing, disciplined exits, and adherence to tested rules. The law is not about avoiding loss, but about ensuring no single loss ends the game. Conclusion: the market's eternal dance. The laws of market movement are not written in textbooks or dictated by regulators. They are etched into the very nature of human behavior. Price reflects judgment, trends persist, cycles repeat, psychology drives, liquidity fuels, volatility breathes. The market is not a puzzle to be solved once and for all, but a rhythm to be read, a dance between fear and greed that repeats across centuries. Those who respect these laws align themselves with the tide. Those who ignore them are swept aside. On Wall Street, survival and success depend on understanding this truth. Markets will always move, and your job is to move with them, not against them. Stock selection and timing. Wall Street is not a level playing field. Every day, thousands of securities trade across exchanges, yet only a handful present true opportunity. Professionals know that success is not about owning a stock, but about owning the right stock at the right time. The dual challenge of stock selection and timing separates amateurs from professionals. One can select a strong company and still lose money if the timing is poor. Conversely, one can pick the perfect moment, but in the wrong security and achieve nothing. Mastery requires both. 1. The principle of selectivity. The first truth in stock selection is that not all stocks are created equal. Markets are driven by leadership. In every bull market, a handful of stocks rise faster, farther, and more persistently than the rest. These leaders capture institutional money, dominate headlines, and set the tone for the broader market. Professionals concentrate on these leaders. They avoid the temptation of chasing cheap laggards or hunting for hidden gems in illiquid corners of the market. Liquidity and sponsorship matter. A leader attracts volume, and volume sustains trends. The law of selectivity states, trade where the action is. The trader's capital must flow to securities that demonstrate strength, momentum, and institutional interest. Knack 2. Characteristics of market leaders. How does one identify a leader? Professionals focus on a combination of price action, fundamentals, and psychology. Relative strength. Leaders outperform the market indexes. While averages drift sideways, leaders climb. Relative strength is a compass pointing to where smart money is moving. Volume confirmation. Price moves without volume are fragile. A true leader shows surges of heavy trading on advances, proof that institutions are accumulating positions. Industry leadership. Strong stocks rarely operate in isolation. A leader typically belongs to a strong sector, one benefiting from broader economic or technological tailwinds. Catalysts. Earnings surprises, product innovations, regulatory changes, or shifts in consumer behavior often ignite leadership. Professionals track catalysts not as predictions, but as explanations for unusual strength. A leader is not chosen because it is cheap or popular. It is chosen because the market itself anoints it through price and demand. Number 3. Timing, the critical factor. Even the strongest stock can produce losses if bought at the wrong time. Timing transforms selection into profit. Wall Street veterans often remind newcomers the right stock at the wrong time is the wrong trade. 3.1 The role of breakouts. One of the most reliable timing mechanisms is the breakout. When a stock consolidates for weeks or months and then surges above a defined resistance level with volume, it signals fresh demand. The breakout marks the transition from potential to performance. Breakouts work because they represent consensus. Investors who doubted the stock are forced to chase. Short sellers scramble to cover. Institutions step in decisively. The result is acceleration. 3.2 The role of pullbacks. Not every entry occurs at a breakout. Many professionals prefer pullbacks, buying after a stock retreats modestly within an established uptrend. A pullback offers lower risk by providing clear levels for stop-loss placement. Timing here demands patience. One waits for selling pressure to exhaust before rejoining the trend. 3.3 Avoiding early entry. One of the classic mistakes is buying too early, anticipating a breakout before it occurs. Premature entries tie up capital, test patience, and increase risk of being shaken out. The professional waits for confirmation. The amateur guesses. The market rewards patience. 4. Time horizons and alignment. Timing is relative to horizon. A day trader seeks intraday setups. A swing trader focuses on days to weeks. A position trader rides months-long trends. Regardless of time frame, the principle is alignment. Trade in the direction of the prevailing trend on the higher time frame. A stock breaking out on a daily chart but trending lower on the weekly may trap the unwary. Conversely, when daily, weekly, and monthly trends align, the probability of success multiplies. Professionals synchronize their trades with the dominant tide. Number 5. The risk of laggards. Chasing laggard stocks, the ones that have not moved while the leaders rally, is a temptation that costs traders dearly. The rationale often sounds logical. This stock has not run yet. It will catch up. But laggards lag for a reason. They lack sponsorship, they lack momentum, and they drain capital. Professionals avoid laggards. They would rather buy a stock making new highs with strength than a stock clinging to old lows with hope. Momentum attracts momentum. Leaders lead because the market votes for them every day through demand. Number 6. The trap of cheapness. Another common error is equating low price with value. A $5 stock is not cheaper than a $50 stock. Price per share is irrelevant. What matters is percentage movement and liquidity. On Wall Street, fortunes are built by percentage gains, not absolute price. A $50 stock rising to $75 delivers the same return as a $5 stock rising to $7.50, but with vastly different liquidity, sponsorship, and risk characteristics. Cheap stocks often prove expensive in opportunity cost. 7. The discipline of exits. Selection and timing do not end at entry. Exit is equally crucial. Professionals define exits before they commit capital. They know where they are wrong and where they will take profits. Stop-loss discipline. Every entry carries risk. By defining a stop-loss just below support or below the breakout level, traders protect capital. This ensures that one bad trade does not destroy the account. Profit targets. While letting profits run is essential, professionals also scale out of positions at logical levels. Previous resistance zones, round numbers, or when momentum fades. Trailing stops. Many ride trends by trailing stops, allowing the market to dictate exit without guessing. An entry without a planned exit is speculation without discipline. Wall Street rewards clarity. 8. Case study logic. No specific copyright content. Imagine two traders watching a stock consolidating at $50. The first buys at 52, anticipating a breakout. The stock dips back to 49, triggering a stop, and he takes a loss. The second waits. When the breakout arrives at 55 with heavy volume, he enters. The move runs to 70. Both selected the same stock. The difference was timing. This illustrates the law. Profit is not in the idea, it is in the execution. 9. The law of patience. Perhaps the most overlooked law is patience. Stock selection and timing are not about constant activity. They are about waiting for the market to present the perfect setup. Professionals may watch a stock for months before committing. Amateurs demand action. Professionals demand confirmation. Patience reduces noise, improves risk-reward, and ensures alignment with institutional flows. On Wall Street, cash is not idle. It is ammunition. 10. Conclusion: selection and timing as a unified skill stock. Selection without timing is incomplete. Timing without strong stock selection is reckless. Together, they form the foundation of professional speculation. The professional trader studies markets with discipline, identifies leaders, waits for confirmation, and enters when probability is highest. He avoids the traps of laggards, cheap stocks, and premature entries. He defines risk at entry and manages exits with precision. On Wall Street, the lesson is clear. The right stock at the right time is not luck. It is the product of observation, discipline, and patience. Techniques of buying and selling. On Wall Street, the art of speculation does not end with the choice of a stock or the recognition of a trend. Selection and timing prepare the ground, but execution determines the harvest. The professional trader knows that buying and selling are not casual acts. They are precise maneuvers governed by rules as strict as any discipline in finance. The difference between a profitable campaign and a costly mistake is rarely the stock itself. It lies in how one enters, how one adds, and how one exits. Execution transforms analysis into results. 1. The principle of buying strength. The first principle of buying is counterintuitive to the amateur. Buy strength, not weakness. Novices are seduced by the idea of bargains, chasing declining stocks in the hope of a rebound. Professionals, by contrast, wait for proof of demand. A rising price confirms that buyers are in control. New highs accompanied by volume expansion signal conviction. Buying into strength means aligning with momentum, not guessing against it. The Wall Street axiom holds true. Stocks are never too high to buy, nor too low to sell when they are moving with force. Strength does not guarantee success, but it places the trader on the side of institutional money, the force that drives markets. 2. The discipline of scaling. In rarely do professionals commit their full capital at once. They scale into positions, probing the market with an initial stake, then adding as the trend proves itself. This technique accomplishes two goals. It reduces risk if the initial read is wrong. It increases exposure when probability improves. A trader might buy 1/3 of a planned position at the breakout, another third as the stock confirms momentum, and the final third when the trend establishes itself. Scaling converts uncertainty into managed commitment. 3. Pyramiding. Riding the trend. Pyramiding is the art of adding to winners. Unlike averaging down, a cardinal sin on Wall Street, pyramiding involves building larger positions as the trade moves in your favor. The logic is simple. If the market confirms your thesis, reward the position with more capital. If the market denies it, cut losses quickly. The pyramiding structure is typically inverted. The largest initial stake is taken at the start. Subsequent additions are smaller, ensuring that risk control is preserved even as exposure grows. The strategy transforms a good trade into a great one without reckless leverage. Number 4. The law of never averaging down. If pyramiding is the professional's weapon, averaging down is the amateur's poison. To average down, adding to a losing position in the hope of recovery, is to throw good money after bad. Markets are merciless. A declining stock may fall further than logic suggests. The professional respects the tape. If the market declares the position wrong, the rule is exit, not defense. On Wall Street, survival depends on cutting losses small. Averaging down magnifies them. The law is iron. Never average down. Never add to a loser. NAF 5. The timing of selling. Buying may initiate the campaign, but selling decides its outcome. The market rewards those who know when to take profits and when to cut losses. 5.1. Cutting losses quickly. The most important sell technique is defensive. Cut losses fast. Professionals enter trades with predefined stop levels, often just below support or the breakout point. This ensures that no single mistake can inflict fatal damage. A trader who loses 5% on a stock can recover. A trader who loses 50% must double his capital just to return to even. Selling early preserves longevity. 5.2. Letting profits run. The corollary to cutting losses is letting profits run. Amateurs sell winners too quickly, fearful of losing gains. Professionals recognize that the big money is made in the big move. They ride trends until the market itself signals exhaustion. The discipline is psychological. Ignore the urge to grab small profits. The market rarely grants great opportunities. When it does, milk them fully. 5.3. Scaling out. Just as professionals scale in, they also scale out. They take partial profits at logical levels, round numbers resistance zones, or after large advances, while leaving a core position to capture extended gains. Scaling out balances prudence with ambition. 6. Reading the tape for exit signals. The tape, or price and volume action, reveals when selling is appropriate. Warning signs include climactic volume surges after prolonged advances, failure to make new highs despite strong markets, breakdown below key support on heavy selling. These signals tell the professional that demand is waning. The exit is not based on hope, but on evidence. 7. The psychology of execution. Execution is as much psychology as technique. The market punishes hesitation and rewards decisiveness. When buying, the danger is fear. Fear of chasing, fear of overpaying. Professionals overcome this by trusting setups and acting when confirmation appears. When selling, the danger is greed. Greed for one more uptick. Greed for the last dollar. Professionals overcome this by adhering to pre-planned exits, not emotions. The execution mindset is stoic. Detach ego, obey rules, accept losses, and preserve gains. 8. Market conditions and strategy techniques adapt to environment. In bull markets, breakouts and pyramiding thrive. In bear markets, short selling replaces buying, with rallies used as entry points for new shorts. In sideways markets, patience dominates. Excessive buying or selling only breeds frustration. The professional adjusts tactics to context. The amateur applies one technique everywhere and wonders why results vary. Option number 9. Case study logic, hypothetical. Consider a stock breaking through $100 on surging volume. A professional buys an initial position. As the stock rises to 110, he adds smaller increments, pyramiding. When the stock reaches 130, he begins scaling out, locking profits while trailing a stop. Meanwhile, an amateur buys the same stock at 100, sells at 105 for a quick gain, then watches helplessly as it runs to 130. Both chose the same stock. Only execution differed. The lesson: execution defines outcome. 10. Conclusion: the art of execution, buying and selling, are not afterthoughts. They are the essence of trading. The market rewards those who buy strength, not weakness. Scale intelligently, pyramid winners, never average down. Cut losses ruthlessly, let profits run. Adjust strategy to market conditions. Execute with discipline, not emotion. On Wall Street, survival and prosperity depend less on the brilliance of analysis than on the precision of execution. In the end, trading success is not about having ideas. It is about buying and selling with professional discipline. Capital management and risk control. Every trader who steps into the market dreams of success. Yet history, from the days of Jesse Livermore to the modern hedge fund era, proves one truth with brutal clarity. The markets are merciless to those who fail to manage capital and control risk. While strategy, timing, and psychology play vital roles, the foundation of long-term survival is built on disciplined capital management. Without it, even the sharpest market calls can lead to ruin. With it, even a modest system can compound into wealth. Why risk management defines success? The stock market is not just a financial arena. It is a psychological battlefield. Prices swing. Volatility tests conviction, and emotions cloud judgment. In this environment, managing risk is not optional. It is the only way to ensure survival. A trader without risk discipline is like a pilot flying without instruments. Eventually, turbulence will strike and disaster becomes inevitable. Capital management provides structure, turning speculation from a gamble into a business. It forces traders to define the cost of being wrong before chasing the reward of being right. Wall Street veterans often say, it's not about how much you make when you win, it's about how much you preserve when you lose. That principle separates amateurs from professionals. Position sizing, the first line of defense. The first element of capital management is position sizing. No single trade should ever have the power to destroy an account. Traders who bet too heavily on a single position often confuse conviction with recklessness. Even the best setups can fail, and markets can turn violently. The disciplined approach is to risk only a small percentage of trading capital per trade. Many professionals cap it at 1 or 2%. This means if a trader has $100,000, the maximum potential loss on a single position is $1,000 to $2,000. Such restraint ensures that even a string of losing trades does not wipe out the account, leaving room to recover when conditions improve. Proper position sizing aligns risk with account size, volatility, and strategy. For example, in highly volatile stocks, a trader should reduce the number of shares to avoid oversized swings. In liquid, stable blue chip stocks, positions can be slightly larger without breaching risk tolerance. This is the mathematics of survival. Small losses are recoverable, catastrophic losses are not. The role of stop losses. Protecting capital. Stop losses are the trader's insurance policy. They are not a sign of weakness, but a hallmark of professionalism. A stop loss is a predetermined exit level that limits downside risk. It removes emotion from decision making and forces discipline. Wall Street history is littered with stories of traders who refused to honor stops. They held on to losing trades, convinced the market would turn in their favor. Instead, losses deepened, capital evaporated, and accounts were wiped out. Jesse Livermore himself stressed the importance of taking small losses quickly while keeping the door open for large gains. A stop loss must be placed based on logic, not hope. It should reflect key levels where the trade thesis is invalidated, whether it is a break of technical support, violation of trend, or shift in market structure. Once placed, it must be respected without hesitation. Risk to reward ratios, shaping probability in your favor. Risk management is not just about avoiding losses, it is about ensuring that potential reward outweighs risk. Professionals evaluate trades through the risk to reward ratio. If a trade risks $1 for a potential gain of $3, the ratio is 1:3. Even with a success rate below 50%, the trader can still achieve profitability. This mathematical edge is what transforms randomness into a systematic pursuit of profit. Retail traders often chase small gains while tolerating large losses, the inverse of success. Professionals reverse this dynamic. They cut losses ruthlessly while allowing winners to expand. Over time, this asymmetry builds capital instead of eroding it. The concept of drawdown, the silent killer. Drawdown is the decline from a peak in equity to a trough. It measures the damage caused by consecutive losing trades or poor capital discipline. The larger the drawdown, the harder it becomes to recover. For example, a 10% drawdown requires only an 11% gain to recover. A 50% drawdown requires a 100% gain to break even. A 90% drawdown requires a staggering 900% gain to recover. This mathematical truth is why controlling losses is paramount. Preventing deep drawdowns keeps capital intact and ensures longevity in the game. Professionals focus less on chasing home runs and more on avoiding devastating setbacks. Diversification, avoiding concentration risk. Risk control also means avoiding excessive concentration in one stock, one sector, or one theme. Even the most promising story can collapse under unexpected news, regulation, lawsuits, geopolitical shocks. Diversification spreads risk across uncorrelated assets, cushioning the impact of negative events. While over-diversification dilutes returns, smart diversification balances opportunity with defense. A trader with positions in multiple industries or asset classes has greater resilience against market shocks. The psychological dimension of risk. Risk management is not purely numerical, it is deeply psychological. Traders fail not because they lack knowledge, but because they ignore their own rules under pressure. Greed pushes them to overleverage. Fear makes them abandon rational exits. Ego prevents them from admitting mistakes. Capital management enforces discipline against these impulses. By predefining risk, traders eliminate the need for emotional decisions in the heat of battle. This is why Livermore emphasized that the greatest enemy of the trader is often himself. Compounding returns, the reward of discipline. When capital is protected, it can grow. Small, consistent gains accumulate over time through the power of compounding. This is the professional's secret. Survival leads to longevity, and longevity allows compounding to work its magic. An undisciplined trader may achieve occasional windfalls, but will eventually face ruin. A disciplined trader who controls risk steadily builds equity. Over decades, this difference becomes monumental. Modern application of classic principles. The lessons of Jesse Livermore and other Wall Street legends remain as relevant today as a century ago. High-frequency trading, algorithms, and global markets have changed the mechanics but not the essence of risk. Position sizing, stop losses, risk-reward ratios, and drawdown control still define survival. Hedge funds and institutional desks may employ complex models, but the foundation remains the same: Never risk so much that you cannot recover, and always protect capital above all. Conclusion: survival first, profit second. Capital management and risk control are not glamorous, but they are the pillars of trading success. Without them, every victory is temporary. With them, every setback is survivable. The essence of professional trading is not chasing every dollar, but preserving the ability to trade tomorrow. As Livermore himself learned through triumphs and failures, wealth is built not by winning every battle, but by staying alive long enough to win the war. In the final analysis, the markets reward not the boldest, but the most disciplined. In Wall Street's unforgiving arena, risk control is the ultimate edge. Trading psychology and discipline. In the arena of Wall Street, where fortunes are made and lost in a single trading session, the most decisive factor in long-term success is not merely knowledge of markets or mastery of technical tools, it is psychology and discipline. Traders often underestimate this truth. They devote endless hours to searching for new indicators, complex models, or insider news. Yet the history of speculation shows that the greatest winners distinguish themselves by mental resilience, not by secret formulas. Trading is not just a battle with the market. It is primarily a battle with oneself. The invisible hand of emotion. Every market tick triggers an emotional reaction. Prices rising spark greed and excitement. Prices falling generate fear and doubt. The volatility of equities, commodities, or currencies is amplified within the mind of a trader, often leading to decisions that are reactive instead of strategic. On Wall Street, professionals understand that markets are governed by crowd psychology as much as by fundamentals. The mass of participants swings between extremes of optimism and pessimism, creating trends, bubbles, and panics. The disciplined trader must learn not only to analyze these waves, but also to resist being swept away by them. Consider two emotions that dominate trading screens. Greed drives traders to chase rallies, add to overextended positions, or ignore warning signs. Fear leads to premature exits, hesitation to pull the trigger, or paralysis at moments when opportunity is greatest. These emotions cannot be eliminated, for they are hardwired into human behavior. The professional does not attempt to erase them, but instead creates a structure to control and channel them. Discipline, the core edge. What separates a consistent trader from the masses is not superior prediction, but unbreakable discipline. On Wall Street, discipline is spoken of with almost military reverence. It is the ability to follow a plan when temptation whispers otherwise, the willingness to accept a loss quickly rather than rationalize it, and the patience to wait for the right setup rather than chase every tick. A disciplined trader lives by rules. Never risk more than a defined percentage of capital on a single trade. Always place a stop before entering a position. Cut losses without debate. Allow profits to run as long as the trend holds. Trade only when conditions align with the system, not when boredom or impulse strikes. These rules sound simple, but their execution requires relentless control. The market will always test the trader's resolve. Every day presents opportunities to bend the rules just this once, and every compromise invites disaster. Building mental toughness. Mental toughness in trading resembles the resilience of professional athletes. Champions are not immune to stress. They are trained to perform under it. Traders must adopt similar conditioning. Key practices include visualization. Before the opening bell, envision possible market scenarios and responses. This rehearsal builds confidence and reduces shock when volatility strikes. Detachment from outcomes. Focus on process, not on the result of a single trade. Success is measured across a series of trades, not in isolated wins or losses. Recovery from losses. Every trader takes losses. The difference lies in the speed and composure of recovery. Dwelling on mistakes clouds judgment. The disciplined operator records the trade, studies it objectively, and moves forward without emotional baggage. Adaptability. Markets evolve. Rigid personalities break under change. Mental toughness means holding principles firmly but tactics lightly. The role of a trading journal. One of the most powerful tools for psychological control is a trading journal. Wall Street veterans treat it as their compass. Every trade is documented: entry, exit, rationale, emotions, and lessons. Over time, patterns emerge, not just in price charts, but in behavior. A journal exposes recurring psychological errors. Perhaps one exits winners too early, or averages down losers against the plan, or trades impulsively after a loss. Awareness is the first step toward correction. Without this record, mistakes repeat silently. With it, the trader builds discipline through accountability. Avoiding cognitive biases. Psychology in trading is not only about emotions, but also about cognitive biases that distort perception. Among the most dangerous are confirmation bias, seeking information that supports an existing position while ignoring contrary evidence; overconfidence bias, believing one's skill guarantees success and ignoring risk; recency bias, overweighting recent outcomes and forgetting the larger statistical reality; loss aversion, holding losing positions too long because the pain of loss feels worse than the satisfaction of gain. Recognizing these biases does not make them vanish, but it equips the trader to question decisions before capital is put at risk. The disciplined professional asks, am I following my system or merely feeding a bias? Patience, the forgotten virtue. Perhaps the rarest quality on Wall Street is patience. Markets move constantly, screens flash with opportunity, and every tick seduces the eye. Yet the best trades come rarely. Livermore, Wyckoff, and other great operators all stressed that waiting is as important as acting. Patience means waiting for the market to confirm your setup, waiting through periods of consolidation without forcing trades, waiting for profits to mature instead of grabbing small gains. Impatience is expensive. It breeds overtrading, higher transaction costs, and mental fatigue. Patience, by contrast, allows capital to compound when true opportunities arise. Discipline under stress. The true test of discipline comes under pressure. A plunging market, a runaway rally, or a string of personal losses can destabilize even the seasoned professional. At such times, survival depends on pre-committed rules. This is why disciplined traders set maximum daily loss limits to prevent emotional spirals, reduce position size after losing streaks until confidence returns, step away from the desk if emotions overwhelm rational thought. On Wall Street, survival is the prerequisite to success. A trader who preserves capital through discipline has the chance to fight another day. The undisciplined trader is soon erased. Integrating psychology with risk management. Discipline is not a standalone concept. It is intertwined with risk management. Every risk rule, from the 2% rule to diversification, serves a psychological function. It limits the emotional damage of a loss. Knowing that no single trade can ruin you allows clarity of thought and prevents panic. A trader who manages risk properly does not fear losing, for losses are pre-calculated and acceptable. This psychological security is priceless. It allows one to follow the system without hesitation, to stay objective amid chaos, and to endure the inevitable drawdowns. The professional mindset. To master psychology and discipline is to adopt the professional mindset. On Wall Street, professionals view trading as a business, not a lottery ticket. They understand capital is inventory to be preserved. Trades are business decisions, not emotional gambles. Losses are operating expenses, not personal failures. Consistency matters more than excitement. This mindset transforms the trader from a gambler into an operator. The professional does not need action every day. He needs only profitable action when the odds align. Conclusion: mastering the inner game markets will always be uncertain. Prices will swing, news will shock, and crowds will stampede. What never changes is the trader's need for psychological mastery. The most brilliant analysis collapses without discipline. The most advanced system fails if greed and fear dictate execution. Wall Street's history is filled with men and women who understood the numbers but not themselves. They rose quickly and vanished faster. The enduring legends, from Jesse Livermore to Paul Tudor Jones, all emphasize the same lesson: control yourself, or the market will control you. In the end, trading psychology and discipline are not optional enhancements. They are the very foundation of long-term survival. Master them, and the market becomes an arena of opportunity. Neglect them, and the market becomes an unforgiving executioner. The journey through the markets is never a straight line. It is a series of peaks and valleys, triumphs and setbacks, tests of skill and trials of character. What separates the survivors from the casualties is not brilliance alone, but the relentless commitment to discipline, risk control, and self-awareness. The greatest traders in history from Jesse Livermore to Paul Tudor Jones, have all preached the same timeless truths. Protect your capital, follow the trend, and respect the psychology of the crowd. Success is never about a single trade. It is about surviving long enough to capitalize on the next great opportunity. If there is one lesson that echoes louder than the rest, it is this: trading is a business. You are the CEO of your own capital. Every entry is an investment decision, every exit a measure of discipline, and every loss a cost of doing business. Treat it casually, and the market will strip you of your wealth. Treat it with respect, and it can offer rewards beyond imagination. But knowledge alone is not enough. You must commit. You must train your mindset daily, sharpen your edge, and surround yourself with a community that pushes you forward rather than holds you back. That is why I invite you to take the next step. Join us at Trading Mindset Lab. Here, we do not chase noise or short-lived trends. We focus on building the trader's greatest asset, the mind. You will find strategies, insights, and mental frameworks designed to help you withstand volatility, cut through confusion, and trade with the confidence of a professional. Wall Street rewards discipline and punishes emotion. The difference between those who thrive and those who quit lies in the ability to master one's own psychology. At Trading Mindset Lab, that is exactly what we train for. So, if you are ready to stop guessing and start trading with clarity and conviction, I encourage you to subscribe to Trading Mindset Lab today. Every decision you make as a trader shapes your future. Make this one count. The market will always be there. The question is, will you be prepared when the next opportunity arrives?